I want to welcome you to our webinar today on comparing pension options. Now, the goal of this webinar is to walk through how to compare and contrast and enter all the multitude of options that become available when we're looking at a very popular retirement income stream. So we're going to be walking through a lot of the logistics of entering this information. We're also going to be walking through how to ensure that we can compare and contrast against multiple proposed strategies, especially when we're trying to look at varying factors from a pension option, whether it's a lump sum pension option or an annual lifetime income option off of a pension. We're going to walk through how to model each of those different scenarios and how those can vary based off of which option we select, of course. We're also going to look at some of the more nuanced aspects of a pension option that might be available for a certain percentage of pensions, which is that idea that especially state pensions in particular can have implications on Social Security income. So we're going to be walking through how to make sure that you are factoring in that into the plan and what that looks like in those scenarios. Towards the end, we're also going to be walking through the different resources that you do have available to you when leveraging RightCapital. One of those resources being that during this webinar, if you have any questions, please feel free to use the questions drop down to type out your questions there. More than happy to engage with any questions you might have. Now, switching gears into RightCapital, the case that we're going to be looking at is going to be the Gilmore family. So starting in Profile Blueprint, before we dive into what some of those different proposed strategies look like, we're going to be walking through what their baseline information looks like. So we're starting in Profile Blueprint, where we can see this nice, easy to understand visualization of their current path. So for their current net worth, they have almost $3 million worth of assets. They also have some outstanding debts and credit card debt, of course, and an outstanding mortgage about to be paid off. They're in their late 50s, and this is going to be an important factor for them as they're on the precipice of their retirement age and determining which pension option they want to take. They also have 2 children that are in the prime age of college age, so we're also going to be looking at some of those college goals in those projections. If we go to goals, we can see across their lifetime, we of course have their children already starting college for this year into next year. We also have a vacation goal that's going to be occurring across a couple years for this family. They're purchasing a car once their children are out of college and they stop paying for that expense. And then we also have them retiring at age 67, which is going to play a part in the conversation we're having today. And just to touch on what their current income, savings, and expenses look like, they do have some nice income streams coming in. They have some nice saving habits. And on that note, they have some nice spending habits as well. Now, to start off today's discussion, we can either have the current plan entry entered in the profile income section or goals or blueprint. Both data entry pieces are going to be the same, but we're going to be starting today's discussion in profile income. So when we are looking at pension options, in the current plan, we're going to be entering which option we want to assume is going to be the current path for the clients. After we enter what the current path is, we're then going to be looking at entering and illustrating some proposed pension options, and we're going to be comparing and contrasting against the current path. But to start out with, we want to just make sure we're establishing what that current option is. So we're going to be starting in profile income. Now, like I said, you can also enter this in profile blueprint under the income, savings, and expenses section, but I'm just going to be entering it in this space particularly. So to start to model a pension option, we're going to be looking at one of the income streams that are coming in as an option for this particular pension. To start to add a pension income stream, we would click on the Add Income button, and then from there we'd add a pension option. With this pension income card, there's going to be a couple key pieces of information that we want to make sure we're entering. The first and foremost option is going to be the annual income that we'd be receiving. For this particular pension option, this is going to be for her age 67. This is going to be Lorelei's pension income stream that we're looking at. And at age 67, her income stream would be an annual amount of $100,000 roughly. For our ease, we're going to be titling these cards so that way, especially when we're looking at the action items later on, we know exactly which pension option this is. So this is going to be age 67, no survivor percentage. The owner is set to Lorelei, so we're going to leave that as is, but if we needed to make modifications, we can illustrate those changes from here. And then very key here is making sure we're entering what age this income stream is going to be starting at. So it's not going to be already started in this case. We can either have it be tied to a calendar year, or in this case, Lorelei's age, and this is for age 67. And the type for this pension option is life only. But if we have the instance in which a pension income stream is going to be only guaranteed for a certain period of time, that is when we're going to see certain only selected. So just for an example, if I quickly toggle to certain only, just to show you guys what that might look like. If we had the circumstance where we're having a pension income stream only paid out for 5 years, for example, that's when you'd indicate type certain only, and then you'd indicate the last year in which they would receive that pension income. In the instance where it's either certain or life, meaning if we pass away before that, that's when we're going to select the second option. But the most popular options are certain only or life only, with life only being that very popular option to model a lifetime pension option. So we're going to keep life only selected. And then we'd indicate what the assumed annual increase is to the income stream. So whether it's a customized increase amount, or we want to tie it to our general inflation figure, or if we want to indicate no increase at all. So in this case, this is going to have a 2.7% annual increase. And then we can also control this increase type, whether it's simple increase or compounding increase. In this case, it's compounding. She's got a nice option for her pension income. And then when relevant, we can also indicate the cost basis and exclusion ratio for this income stream. Now, for certain aspects of the pension income data entry, we're going to see little info blips that you can always reference after this webinar for additional information. Of course, you're also going to receive the follow-up recording in a follow-up email, because I see that's already a question. So you'll also have that for reference. But just for your ease, when you're entering data in an actual plan, you're also going to see this available as well. So this is going to be relevant for those non-qualified pension options, and this is going to be determining that taxable basis. Another very important aspect for today's conversation is the survivor percentage, meaning how much of the income stream is going to be essentially inherited by any surviving spouse. So in the event that Luke lives longer than Lorelei, if we have any survivor percentage going on, we're going to see that indicated based off of what we enter here. This particular option for the current plan is no survivor percentage. So we're going to leave that at 0. And then a very important selection here that's going to have a direct impact to Social Security benefits in particular, if applicable, is the non-covered election field. So this non-covered election box is what we would check off in the circumstance where we have a pension that's going to be considered non-covered. But what that means is that typically it's paid by an employer that does not withhold Social Security taxes from the client's salary. And this is very typically a common aspect of state or local government workers. So typically it's referred to as a state pension. If that's the case, there's going to be potential implications to somebody's Social Security benefits. So if we check off this box, there's 2 different things that can be impacted for Lorelei or the client. The first one is going to be WEP, or windfall elimination provision, and that would be benefits being potentially reduced for her own Social Security benefits, for her own retirement benefits. The second thing that might be impacted, if applicable, is government pension offset, or GPO. And that would be to her spousal benefits if she was going to be eligible to receive that, or survival benefits as well. So it's not going to impact the spouse in the plan, it would just be impacting Lorelei's Social Security situation. And I'm going to cover in a second what we can do to ensure we're capturing some of the logistics of this a little bit more accurately. The final field in this pension income card that we can also enter is if we have the situation where this is going to be state tax exempt, we can check that off from here. Once again, we're always going to have these info blips for reference as well. It's not the case for this situation, so we're going to actually leave that deselected and hit save. So especially if we're looking at the situation where somebody is going to have a non-covered pension, I want to briefly touch on the implications that that can have on for Social Security, because that's going to be a key concern for somebody that is in the instance where they have a very sizable pension in this circumstance, especially, and how that might be impacting their Social Security benefits. So like I said, this would have a direct impact to Lorelai's Social Security benefits, whether it's her own or to survival or spousal benefits. But if we click into the Social Security card, I just want to walk through a couple pieces here that we want to make sure are in line to ensure that we're also going to be calculating WEP, windfall elimination provision, or GPO. So just for reference, when we're looking at entering and modeling Social Security income, there's two main fields that we specify what's happening with the Social Security picture. The first one is where we enter when we assume the client is going to file for Social Security. Right now for Lorelai, it's assumed that she's filing at full retirement age, or FRA, which is based off of her birth date. If we use this dropdown, you can model her filing at different ages. But what's going to be important for today's discussion surrounding pension income that's non-covered specifically is going to be what we entered for estimated benefit amount. So if we use this dropdown, there are 4 different options for how we model Social Security income. The first one is no Social Security. I want to note that if we enter no Social Security here and hit save, this is going to be turning off Social Security calculations for this client, and this would include any sort of impact we might have seen if we have any non-covered pensions. This is indicating she's not going to receive Social Security at all, whether it's her own retirement benefit, any spousal benefit that would have been automatically calculated as well, and any survivor benefit. So it's going to be completely turning off that calculation. If we have this selected, we're not going to really see an impact to Social Security for Lorelai, of course, because there's not going to be a Social Security. But for the remaining options, for use simple estimate, this is going to be an option that we can select that will use Lorelai's active salary to project forward and backwards what her historical covered earnings are to then project her Social Security benefit. If we have this selected, this is a great option for if we don't have the full picture of what her Social Security benefits look like. This will be incorporating that idea of any implications and automatically be calculating with the system and what we entered in pension income for that non-covered pension, how that's going to impact her benefits in terms of any sort of windfall elimination provision impacts or GPO. Because with the system, if we have both client and co-client filing for Social Security, we're automatically going to be considering if anyone's eligible for spousal benefits or survivor benefits. That's automatically going to be calculated based off of what we enter here. And that includes any implications from WEP or GPO if we have use simple estimate selected. Another very important thing to note is that if we have based on Social Security statement value selected for our estimated benefit amount, this is what we'd indicate if we have a statement from the Social Security Administration. Now, in almost all cases, when you receive an actual statement, especially when you're closer to filing age from the Social Security Administration, that's going to be a reduced amount. So this amount particularly is not, and if we select this option, is not going to see an impact if we selected a non-covered pension option, because it's going to be assumed here in this based on Social Security statement value amount that we're entering, that this is pre-reduced with any sort of implications from any impacts from that non-covered pension or WEP. So the final option here for the estimated benefit amount is entering based on historical covered earnings. Now, this is probably going to be the most popular option for entering Social Security filing options and that calculation if we have a non-covered pension. And that's because if we have a non-covered pension, typically that means that we've been working for the state, for example, for at least a certain period of time. In order to qualify for Social Security benefits, we would have had to have been contributing to the Social Security program, meaning our employer would have had to have been withholding Social Security taxes from our salary. In those instances where we might have worked a job previously that we were contributing to that Social Security benefit, we're going to have a specific amount of covered earnings. So entering here those specific covered earning years and what that looked like for the client can also provide a very precise calculation in terms of WEP or GPO and also the Social Security benefit, especially considering that if they were working different careers, those income streams can definitely vary very drastically depending upon what happened in their lifetime, of course, So this is a way to also consider that calculation and the implications from WEP or GPO. In this case, though, we're going to be keeping use simple estimate selected and hitting save. I also want to note a very important designation here for salary, because I also see somebody's already asked a question about this, and it's a great point. For W-2 salary, if we click into this card, there's also a field to indicate that we want to exclude this salary income for Lorelei from Social Security tax. So if we're assuming that Lorelei is still working for the state, for example, and she's going to be excluded from Social Security tax, we can check this off, but this is going to have an implication in terms of if we were using simple estimate, since it's going to be looking for an income stream that's contributing to essentially that Social Security benefit or that government program. So we're going to keep this deselected and hit save, because in this case, she was previously a state worker. So her current income stream is not going to be subject to that situation. But those are just some important aspects to understand when looking to illustrate the implications of WEP or GPO that I just wanted to briefly go over, especially in the profile section. But now that we have the current plan and the baseline information set up, we're going to be looking at illustrating some additional pension options. So now we're going to be going into the retirement module. And in the retirement module, we're going to be greeted with our analysis tab. This is where we're going to find that probability of success. The probability of success is going to be looking at the Monte Carlo simulations, or the 1,000 trials of market volatility, and it's the percentage of those trials that make it to the end of plan without running out of money. So in this case, with the current path and that nice steady stream of income coming from the pension, we have 100% probability success, which is great. But as we know, there's a lot of different paths available for a client, and especially when we're looking at modeling pension options, there's going to be a couple options we're going to be illustrating today. So to start to illustrate a proposed plan, that is when we go down to the action items, and this is where we can go to make proposed changes. Now, what we're indicating here in the action items is only going to be impacting our proposed plan. So it's not going to be impacting our current plan. So whatever we indicate here is going to be a space for us to create proposed strategies. Now, to start off with, we're going to click into the edit button in the action items to include our pension income stream. So the first thing that we're going to be doing when we click into the edit drawer, this is going to be a space that allows for us to add or remove existing action items. And so we're going to be starting with just turning off that pension income stream that we entered in the current plan. So that way we can have the idea of a different kind of plan altogether in our proposed strategy. So we're going to check off that income stream and hit save. What that's going to do is it's going to bring that into the action items for us to be able to propose a change to. So in this situation, we're actually going to zero this out, whether we use a slider to indicate that or type out the number 0 here, and we're going to hit refresh, and that's then going to save this change for the proposed plan. So just for an example, if we didn't even have the pension income option, we're going to have an 89 probability success. We can see that from here, but we do have another option we're looking to evaluate for this client plan, which is the idea of potentially getting a survivor percentage pension income stream. So the first thing we're going to do now is click on the edit button once again. It's going to open up that drawer where we can either add or remove existing action items. And it's also a space for us to be able to propose a new action item. So we're going to be selecting the add new items button. From here, we're going to be adding that secondary pension income option. That's a very common option to be debating between, is the income, pension income, of course. And in this one, it's going to look a little bit different because we're evaluating a pension income stream at age 67 with survivor percentage. So this particular annual amount is going to be $48,000. In this case, the owner is Lorelei. The income starts would be Lorelei's age 67 once again. It's life only. In this case, it's going to have a similar annual increase compounding. And in this case, there is a survivor percentage. So we're going to leave that at 50 because that's the option we're looking at. We're also going to check off that this is non-covered as well and hit save. And once we hit save, we're now going to see how that's going to impact this proposed plan. Now, before we walk through comparing and contrasting visualization, I want to model a third option for this potential plan, which is a very common option to evaluate, which is a lump sum option. So to start to evaluate that lump sum option, we need to create another proposed plan. To create multiple proposed plans, we would click on the pencil icon next to where it says current plan. That's going to open up a drawer in which we can either add or remove existing proposed strategies. Now, when we're looking to create an alternative scenario, we have two options for how we can do so. The first one is to indicate add new plan via this button, and that would essentially copy the current plan for us to build off of. Or we have the option to copy off the existing proposed plan. When we hover over it, we're going to see a copy button and build from there. So let's say that's what we're going to be doing. So we're going to hit the copy button. And when we add a new proposed plan, we can retitle this. So this case is going to be Lorelei's pension option. And we're going to hit the check mark to save the name change. And then we're going to hit the OK button. So now that we just indicated that additional proposed plan, we're going to see the ability to toggle this drop down to that new proposed strategy, which is Lorelei's lump sum pension. So when we toggle to this option, and it's very important that we toggle to this option on the left-hand side of the screen, as this is going to be the main one that we're modifying when we're making changes to those existing action items. So if we now scroll down to the action items, once again, when we're looking at creating that alternative scenario, we want to just make sure we are, in fact, zeroing out those existing entries for the pension income to have a kind of starting from scratch situation. Now we can also hit the reset button to go back to the current paths entry, but in this case, we just want to zero out those proposed plans. So we're going to be clicking on the edit button, and to model a lump sum option, we would go to add new items, we go to savings, and then we go to other, and then tax deferred. Now, if this is going to be part of the current plan, we'd actually enter this under profile, and it would also be found under savings, other, tax deferred. In this case, though, this is going to be a proposed strategy we're evaluating. So we're going to be adding it here. So in this tax deferred card, we would enter the savings name, so that way we know this is a lump sum option for our reference when looking at the action items. And then we're going to be entering the amount that would be received. So this is going to be for the at age 67 amount of $345,000. Owner is Lorelei, but we can change it if needed. And then we want to have the start and stop at the same time to show the one-time lump sum. So this is going to be Lorelei's age 67. Her retirement age is the same, so we can definitely tie it to that age, but we're just going to be entering the specific age here. And then we indicate towards which type of tax deferred asset it be going to, whether it's the 401k type bucket or traditional IRA bucket. In this case, it's going to be 401k for her path. And then we're going to hit save. Once we hit save, we're then going to see that impact this proposed strategy. And then we can start to compare and contrast options. Now, before we start to do so, I want to backtrack to our original proposed plan. One thing to note, when we do propose a new action item entirely, it's also going to be available in different proposed plans we already have established. So if we go into the action items, I just want to make sure that I zero out that pension option for the lump sum pension option by going down to savings and getting to 0 and then hitting refresh. So that way we can isolate the age 67 with survivor benefits. But now that we have both of those indicated, and now we have 3 different pension options to compare and contrast against, the first kind of comparison visuals that we have available to us are going to be, of course, what we're seeing already, which is the probability of success. So this is going to be comparing that probability of success, and we can toggle both drop downs between the 2 different scenarios. But let's say right now we're trying to illustrate just the proposed plan versus current plan, proposed plan being the one with the age 67 pension income stream with survivor percentage of 50% versus current plan that does not have a survivor percentage. Here we can see, and a big concern for this client, I should backtrack and say, is just guaranteeing that in the event where Lorelei passes away earlier than Luke, that he has some guaranteed income. So that's going to be a concern for this family. And if that's the case, we can see here that even when we take that option that does have a survivor percentage, that we still have 100% poverty success. So it's still looking like a positive aspect in this situation. Another comparison visual that we have available to us is of course found under that comparisons tab, which is aptly named. The comparisons tab and these 3 sub tabs I want to just quickly note are going to be pulling from the cash flow level projections. And we will be diving into cash flow level information in just a couple minutes, but it's just important to note that this is a different calculation than probability of success. Comparisons and the cash flows projections is looking at a straight line projection, which means it's not factoring in volatility to the baseline. And now you can apply different sequences of return by changing the baseline, but we're going to be sticking to just baseline for now. With the comparisons visual, this is where we can show that difference between our proposed plan and the current plan and how much more or less we're going to have in invested assets with either strategy. We can also see the difference of net worth. We can also see the difference of taxes and also the difference of assets at retirement as well. So a big portion of this conversation for the client in particular is just guaranteeing some stable income, especially when Lorelei potentially might pass away sooner than Luke. If that's the case, it's that pros and cons list, of course. But if we go to the retirement details, another big conversation is about having stable income. Now, when we're trying to look at the income stability percentage, we're going to be able to find that at the retirement details tab when looking at the income sources visualization. This is going to be focusing on what's happening in retirement specifically. And for the income percentage that's stable, this is going to be looking at things like Social Security income, pension income, and annuity income if we had that as well. So we can see here what's happening across their lifetime and how much we're receiving in the chart from Social Security and pension income. There are also going to be a couple other key pieces here as well, but the main piece when we're looking at things like pension, and especially if we're trying to compare and contrast against the idea of taking a lump sum, we can see how that's going to have a different stability income percentage. If we switch over to lump sum pension, we'll then see how that's going to be kind of taking away from that stability income ratio because we're no longer going to be having that pension income stream. We're just going to be essentially investing that lump sum pension into the 401k. So this is going to be one of the spaces to have that comparison visualization and the conversation about our priorities and about which path might be best suited. To dive into some of the cash flow level detail for pension options, we would navigate to retirement and then into the cash flows. In the cash flows module, we're going to see 2 spaces to have this discussion. The first space that we're going to see here is going to be the maps visualization. This is going to be just a nice sand key visualization of the client's income inflows and what it's going to be funding for a specific year of the cash flows. So where we're looking to have just a nice visualization of the cash flows, we can either access the waterfall or the breakdown visualization. But if we're trying to isolate to when the pension income stream is coming in the current plan, we can toggle to that year of the cash flow using that slider. And we'll see here what's happening for pension income. This case it's 100,000 because that's what's happening in the current plan. Plus we have some Social Security kicking in, and then we see what's happening for expenses as well and any net negative cash flows. We also have that breakdown visualization of the same information as well for reference. And we can also toggle between our different plans by using this drop down. So if we are looking to maybe compare and contrast here, we can use this toggle to maybe switch over to what's happening with the Lorelei's lump sum pension plan. So especially if we're just looking to illustrate what would happen if we did select that, especially if we're trying to look at the comprehensive options, we can see here that, of course, if we don't have the pension income, there is a gap in terms of our income needs, and a lot more of our income or our outflows is going to have to rely on pulling from assets. To dive into further detail, we do have, of course, the summary tab. In the summary tab, this is going to be a year-by-year breakdown across the client's lifetime of their cash inflows and cash outflows. So this is also where we can see similar information, but this is going to be a very familiar balance sheet or summary cash flows look. So to start to have a deeper dive discussion about some of the details specifically surrounding Social Security income and pension income, we're going to toggle quickly to one of our different scenarios, proposed plan, because that's going to have our pension income. And then we can click into each of these column headers for additional information. So if we're trying to dive into what's happening with Social Security income and pension income, we can click into the income inflows column header. We're then going to see a Social Security column and a pension income column. And we can click into each of these for additional information. So we can see for reference what I titled the pension income card, which is that this is the age 67 pension income stream with survivor benefits. And if we back out, we can see for Social Security income, what is happening for their own retirement benefit. They're both pretty even in terms of the benefit, so there's not going to be any spousal for this situation. So we're going to be able to dive into each of those different options here. If we're looking to see the implications of the idea of somebody, especially Lorelei, passing away early, just to illustrate the impacts of that particular option of the pension income stream, I want to highlight what that looks like because I see that's also a question. So just a reference for the Gilmore family, right now we have them passing away at the same time. But if we're looking to assume that maybe Lorelei passes away a little earlier across all scenarios, we can establish that under Profile Family, clicking into Lorelei's client card, and this is where we can go to adjust her planning horizon. Planning horizon is giving the age at which we are assuming that she passes away. So we're going to toggle to 90 here, hit save, and just for reference, Luke is indicated as passing away age 95, so we've got a couple years here where he's going to need some of that income stream if they were looking to evaluate that survivor percentage. So that's going to be one of the ways we can model that particular option. Let's toggle to that proposed plan so we can compare against the two options here. And we can also see what's happening in cash flows as well. So if we're trying to show that level of detail of the particular option with the survivor percentage, we can see what's going on here by scrolling further down, and we can even click into the pension income. And we'll see that even when Lorelei passes away, we do have some remaining 50% of that income roughly being inherited essentially by Luke. So he's still going to have some income stream. So if we're looking to evaluate those different options with the idea of the client or co-client having a different planning horizon, you definitely can model that by modifying the planning horizon in Profile Family or changing that assumption in your proposed plans. One other thing that we're going to be referencing before we dive into resources is creating reports that can illustrate a lot of the comparison visuals we covered today. So if we go to the gear icon report section real quick, this is where we go to check off what we want to include in a PDF report. Now, especially if you are looking to have multiple plans included in this PDF report, I'm going to highlight how you can do so for what we reviewed today. So to start with, for the retirement analysis and cash flows, we're going to be seeing here that both of these are underlined. That means that we can click into it for more functionality. So for analysis, when we click on that header, we can then use this drawer to be further refined in terms of what sub-tab selections we're including in the PDF report. So if we wanted to remove anything, we can certainly do so by checking those off. Maybe we're just looking at isolating income sources and that stability income percentage. But especially in this circumstance, we have multiple plans we want to include in the PDF report. That's when we can toggle to select plans, and that'll allow for us to include multiple proposed strategies. So if we want to include all of them or more if we had them, we can check those off from here. Similarly with cash flows, we can click into the cash flows column and then be further refined in terms of what we're including here. So maybe this is an instance in which we're just going to be looking at ending balance by accounts, additions to accounts, and then focusing on summary and those visuals. And then here we also can toggle to select plans. So if you wanted to show the comparing idea of the current plans, pension income stream versus proposed, we can select both of those, or we can select all three of these as well. And then we can also check off blueprint to include those visuals we reviewed earlier. And then once we're ready, we can hit download selected pages. But that's how you can curate a PDF report that is going to encompass the ability to have multiple proposed plans in those key spaces that you're probably already touching on in the retirement module specifically.